Welcome. Today, we're unlocking the basics of accounting, the language every business uses to tell its story. Accounting helps us understand what a business owns, owes, and is worth, making sense of money, whether for a company or your own life. Learning this language gives you the power to make smart decisions, track your finances, and see the bigger picture. Ready to get started? Let's break accounting down together, step by step. Let's learn the language of business. To start learning any new language, you first need to learn the basic words. In accounting, the three most important words are assets, liabilities, and equity. Let's begin with the first one. Assets. An asset is anything of value that you own. Think about the things you have right now. The cash in your wallet is an asset. The smartphone you're likely holding or have nearby is also an asset. If you own a car, that's a valuable asset. These are all resources that have economic value and can be used to generate future benefits. For a business, assets could also include its office building, computers, and inventory. Next up, we have our second key term, liabilities. This word might sound a bit intimidating, but the concept is quite straightforward. A liability is anything you owe to someone else. It represents a debt or an obligation that you need to pay back in the future. A very common example is a loan. If you borrowed money from a bank to buy your car, that car loan is a liability. The balance on your credit card bill is another perfect example of a liability. It's money that you owe to the credit card company. For a business, liabilities would include things like bank loans or money owed to its suppliers for materials. Now for our third and final building block, equity. This one can sometimes feel a little abstract, but we can make it simple. Equity represents the value that is left over after you subtract what you owe, your liabilities, from what you own, your assets. Think of it as your net worth. Let's go back to your car. Imagine your car is worth $10,000. That's the asset. You still have a loan of $3,000 on it. That's the liability. Your equity in the car would be the difference. $10,000 minus $3,000, which equals $7,000. It's the portion of the asset that you truly own, free and clear of any debt. So let's put it all together with a simple summary. Assets are the valuable things you own, like your phone and cash. They are the resources that help you. Liabilities are the debts you owe to others, like a loan or a credit card bill. They are claims against your resources. And equity is what's left for you after all your debts are paid off. It's your piece of the pie. These three concepts are the absolute foundation of all accounting. Understanding them clearly is the most important first step. Once you have a firm grasp on these ideas, everything else we learn will start to fall into place much more easily. Now that we know our three key terms, assets, liabilities, and equity, we can put them together to form the single most important rule in all of accounting. This rule is called the accounting equation, and it's beautifully simple. It looks like this. Assets equals liabilities plus equity. This equation must always be in balance. It's like a perfectly balanced scale. On one side, you have all your assets, which are all the resources you have. On the other side, you have the claims on those resources, which are divided between what you owe to others, liabilities, and what you own yourself, equity. Let's see this equation in action with a very simple example. Imagine you want to start a small business, a lemonade stand. You start with $20 of your own money that you put into the business. In this case, your business now has an asset, $20 in cash. Where did this asset come from? It came from you, the owner. So the business has $20 in equity. Our equation looks like this. Assets, $20 equals liabilities. $0 plus equity, $20. See how it balances? $20 on the left side equals $20 on the right side. Everything is in perfect harmony, and our financial story is accurate. Let's make it a little more interesting. Your lemonade stand needs a fancy new pitcher that costs $10, but you don't have enough cash. So you borrow $10 from your parents. Now, what happens to our equation? Your assets have increased because you now have $10 in cash from the loan, in addition to the $20 you started with, for a total of $30 in assets. But you also have a new liability, the $10 you owe your parents. Your equity, which is your own investment, is still $20. Let's check the equation. Assets, $30 equals liabilities, $10 plus equity, $20. Once again, it balances perfectly. $30 equals $30. This fundamental equation is the bedrock of what is known as the double-entry accounting system, which has been used for hundreds of years. Every single transaction that occurs in a business affects at least two parts of the equation, ensuring it always remains in balance. When the business buys something, sells something, or borrows money, the equation adjusts, but it never breaks. This constant balance is what makes accounting such a reliable and trustworthy system for tracking financial activity. It ensures that for every action, there is an equal and opposite reaction recorded, leaving no room for unexplained changes in the financial story. Now you might be thinking, this is interesting, but why do I need to follow this strict equation? Can't I just keep a simple list of what I spend and what I earn? That's a great question. You certainly could, but it would be like trying to ride a bicycle without any wheels. You have the frame, the handlebars, and the pedals, but you won't get very far. A simple list of transactions is a good start, but it doesn't give you the full picture. You wouldn't know your net worth, you couldn't easily see who you owe money to, and you wouldn't have a clear understanding of your financial position at any given moment. An accounting system, built on the foundation of our equation, is what gives your financial management its wheels. It provides structure, balance, and momentum. When you properly track your assets, liabilities, and equity, you can see not just where your money went, but also how that transaction affected your overall financial health. Did it increase your assets? Did it add to your debt? Did it grow your personal stake, your equity? These are the deeper questions that a simple list can't answer. A proper system allows you to steer your finances with purpose, making informed decisions based on a complete view of the landscape. Imagine trying to navigate a long and winding road on that wheelless bike. It would be incredibly difficult, slow, and frustrating. You would have to drag it every step of the way. This is what running a business, or even managing your personal finances, feels like without a proper accounting framework. You're essentially flying blind. You might feel like you're making progress, but you have no reliable way to measure it. You can't see the hills and valleys ahead, making it impossible to plan for the future. You are reactive instead of proactive, constantly dealing with financial surprises as they pop up. With the wheels of accounting firmly in place, your journey becomes smoother and more efficient. The system does the heavy lifting for you, organizing every transaction into the right category and keeping the equation in balance automatically. This allows you to look up from the nitty-gritty details and see the bigger picture. You can spot trends, identify opportunities for growth, and catch potential problems before they become serious. It gives you the control and confidence to not just ride your financial bike, but to race it towards your goals, whatever they may be. It transforms a chaotic process into an orderly and powerful tool for success. You have learned so much already. We've talked about what accounting is, defined assets, liabilities, and equity, and even balanced the fundamental accounting equation. It's time to put your new knowledge to a quick and fun test. This isn't for a grade, of course, but just to help you check your understanding and build your confidence. Ready? Here is your very first accounting quiz question. Take a moment to think about the definitions we just covered and see if you can find the right answer. Don't worry, it's designed to be a gentle first step into applying what you've learned. Here is the question. Which of these is an asset? A, a loan you need to pay back. B, your cell phone. C, your monthly credit card bill. Think carefully. An asset is something valuable that you own. A loan and a credit card bill are things you owe to others. Therefore, the correct answer is B, your cell phone. Your cell phone is a resource you own that has value. The loan and the credit card bill are excellent examples of liabilities. If you got that right, fantastic. You are already thinking like an accountant. If you were unsure, that's perfectly okay too. The most important thing is to understand why B is the correct choice. This little quiz is just the beginning of your journey. Today, we laid the groundwork, the absolute essential foundation upon which everything else in accounting is built. You now understand the core vocabulary and the golden rule that governs the language of business. This is a huge accomplishment, and you should be proud of the progress you've made in such a short time. Learning any new skill is a marathon, not a sprint. and you've just taken a very strong and confident first step. The key is to keep that momentum going and to remain curious about what else there is to discover. So, what's next on this adventure? In our next lesson, we are going to dive into type of accounts and how to record transactions. We will approach it in the exact same way we did today, with simple explanations, relatable examples, and a friendly, step-by-step pace.